Booyah! Welcome to the exciting world of investing. The stock market is a dynamic and ever-evolving arena where fortunes can be made and lost. It's a place where companies and investors come together to trade shares, and it's been a cornerstone of the global economy for centuries. The stock market can seem intimidating at first, but it's really not that complicated. At its core, it's a marketplace where buyers and sellers come together to trade stocks, which represent ownership in a company. Just like any other market, prices are determined by supply and demand. Think of it as a giant auction where companies sell pieces of themselves called stocks to raise money. These stocks are then bought and sold by investors who hope to make a profit. The stock market operates through exchanges like the New York Stock Exchange or NASDAQ, where these transactions take place. When you buy stock, you're buying a tiny ownership stake in that company. This means you have a claim on part of the company's assets and earnings. The more shares you own, the greater your ownership stake. As a shareholder, you have the potential to profit in two ways: if the stock price goes up, and through dividends, which are portions of the company's profits paid out to shareholders. Dividends can provide a steady income stream, while capital gains from rising stock prices can significantly increase your wealth. The stock market is important because it allows companies to grow and create jobs. By raising capital through the sale of stocks, companies can invest in new projects, expand their operations, and drive innovation. This, in turn, leads to economic growth and job creation. It also gives everyday people like you and me the chance to grow our wealth over time. By investing in the stock market, you can take advantage of the power of compounding, where your investment earnings generate even more earnings. This can help you achieve your financial goals, whether it's saving for retirement, buying a home, or funding your children's education. Remember, knowledge is power. So buckle up, because we're about to dive into the basics of investing and empower you to take control of your financial future. We'll cover everything from how to choose the right stocks to understanding market trends and managing risk. Are you ready? Let's do this. Buying and selling stocks is easier than ever thanks to online brokerage accounts. These platforms act as your gateway to the market. Think of them like your online shopping cart, but instead of clothes and gadgets, you're buying and selling pieces of companies. Once you've chosen a brokerage, you'll need to fund your account. Then it's time to research and select the stocks you want to invest in. Remember, every stock is different. When you're ready to buy, simply enter the stock symbol, a unique code for each company, the number of shares you want, and place your order. Selling is just as easy. Just reverse the process. Remember, the key is to buy low and sell high. Not all stocks are created equal. Each stock tells a unique story, reflecting the company's journey, market position, and future potential. Understanding these differences is key to making informed investment decisions. There are different types of stocks, each representing a different type of company and carrying different levels of risk and potential reward. Some stocks are tied to well-established companies with a long history of stable performance, while others are linked to newer, more volatile enterprises. First, we have common stock, which is what most people think of when they hear the word stock. Common stockholders are essentially part owners of the company, and they benefit from the company's success through price appreciation and dividends. However, they also face the risk of losing their investment if the company performs poorly. It represents ownership in a company and gives you voting rights. This means you can have a say in major company decisions, such as electing the board of directors or approving significant corporate policies. This level of involvement can be appealing to those who want to influence the direction of the companies they invest in. Then there's preferred stock, which typically doesn't come with voting rights but offers higher dividend payments. Preferred stockholders are prioritized over common stockholders when it comes to dividend distributions and asset liquidation, making it a more stable investment option for those seeking regular income. We also have growth stocks, which belong to companies expected to grow at an above-average rate. These companies often reinvest their earnings into the business to fuel further growth, rather than paying out dividends. Investors in growth stocks are typically looking for substantial capital gains over time. On the other hand, value stocks are considered undervalued by the market and are often priced lower than they should be. These stocks are typically associated with companies that have solid fundamentals, but may be temporarily out of favor with investors. Value investors seek to buy these stocks at a discount, with the expectation that their true value will be recognized over time. Understanding the different types of stocks is crucial for building a diversified portfolio that aligns with your investment goals. A well-diversified portfolio can help manage risk and improve the potential for returns by spreading investments across various types of stocks. Whether you're a conservative investor looking for steady income or an aggressive investor seeking high growth, knowing the characteristics of different stocks can guide you in making better investment choices. Now that you understand the basics, let's talk strategy. Investing can seem overwhelming at first, but with the right approach, you can make informed decisions that align with your financial goals. There are many different ways to approach investing, but here are a few simple strategies for beginners. First, it's important to educate yourself about the different types of investments available. Stocks, bonds, mutual funds, and ETFs each have their own characteristics and risks. One popular approach is value investing, where you look for undervalued companies with strong fundamentals. This strategy is often associated with legendary investors like Warren Buffett, who seek out companies that are trading for less than their intrinsic value. Another is growth investing, where you focus on companies with high growth potential. These are often tech companies or startups that are expected to grow at an above-average rate compared to other companies. You can also choose to invest in index funds, which are like baskets of stocks that track a specific market index, such as the S&P 500. Index funds offer a way to invest in a broad market segment without having to pick individual stocks. This is a great option for beginners as it offers instant diversification. Diversification helps spread risk across different assets, reducing the impact of any single investment's poor performance on your overall portfolio. Remember, there is no one-size-fits-all approach to investing. What works for one person might not work for another. It's crucial to tailor your investment strategy to your own financial situation and goals. The best strategy for you will depend on your individual financial goals, risk tolerance, and time horizon. Are you saving for a short-term goal like a vacation or a long-term goal like retirement? Understanding your objectives will help you choose the right investments. Additionally, consider how much risk you are willing to take. Higher potential returns often come with higher risk, so it's important to find a balance that you are comfortable with. Finally, think about your time horizon. The longer you can keep your money invested, the more you can benefit from the power of compounding. By considering these factors, you can develop a strategy that works for you and helps you achieve your financial goals. Section 5. Risk and reward. The flip side of the coin. Investing in the stock market involves inherent risks. The value of your investments can fluctuate, and you could lose money. It's important to understand and accept this risk before you invest. Market risk is the risk that the overall market will decline, affecting the value of your investments. Company-specific risk, on the other hand, is the risk that a particular company you've invested in will perform poorly. To mitigate risk, it's crucial to diversify your portfolio, which means spreading your investments across different asset classes, industries, and geographic regions. Remember, don't put all your eggs in one basket. Section 6. The long game patience and the power of compounding. Investing is a marathon, not a sprint. Don't expect to get rich quick. The key to success in the stock market is patience and a long-term perspective. One of the most powerful tools at your disposal is compounding. When your returns are reinvested, they generate even more returns over time, creating a snowball effect. Remember, time is your greatest asset when it comes to investing. The earlier you start, the more time your money has to grow. Section 7. Don't be a fool. Common investing mistakes to avoid. Even seasoned investors make mistakes, but there are some common pitfalls that beginners can avoid. One of the biggest mistakes is letting emotions dictate your investment decisions. Don't panic sell when the market takes a dip. Remember, volatility is normal. Stick to your investment plan and focus on the long term. Another common mistake is chasing hot stocks or trying to time the market. Instead, focus on investing in companies with solid fundamentals and a proven track record. Remember, knowledge is power. The more you learn about investing, the better equipped you'll be to make informed decisions and avoid costly mistakes. Section 8. Beyond the stock, diversifying your portfolio. While stocks can be a great way to build wealth, it's important to diversify your portfolio beyond just stocks. Consider including other asset classes such as bonds, real estate, and commodities. Bonds are less risky than stocks and provide a steady stream of income. Real estate can be a good long-term investment, while commodities can help hedge against inflation. By diversifying your portfolio, you can reduce your overall risk and potentially enhance your returns. Remember, don't put all your eggs in one basket. Section 9. The final word. Take control of your financial future. Congratulations! You've taken the first step towards mastering the stock market. Remember, investing is a journey, not a destination. Keep learning, stay informed, and don't be afraid to ask for help along the way. The stock market can be a powerful tool for building wealth and achieving your financial goals. So what are you waiting for? Start investing today and take control of your financial future. Remember, the only bad investment is the one you don't make. Now go out there and make some money. Booyah!